it takes sometimes a certain amount of courage to take risk, and crisis markets and fast markets are the time when you make money, right? Like when it's slow and quiet, it's just harder to make money. Volatility is what you want as a trader.
Hi everyone, and welcome to my life in 4 trades. I'm Andreas Larsen from the Real Vision community, and it is my pleasure to host one of the best traders that I know, Brent Donnelly, for a discussion on his life in 4 trades today. Brent, welcome to the show.
Hey Andreas, great to see you.
Yeah, it's good to see you too, Brent. Brent, you're currently the president of Spectra Markets, but you have a long career behind you in, for example, FX trading in top-tier banks in the US. But before we get to the 4 trades that sort of painted your life in trading, I would like to get a brief introduction to you as a trader and how you got into finance. So please enlighten us a bit on your career.
Sure. So as you said, I have been a spot FX trader for most of my life, but I did some other stuff in between. I was trading my own money for 5 years, trading single names during the dot-com bubble. And I traded at a hedge fund for 3 years as well. So I've kind of traded like a lot of different capital sizes, which I think has given me a different perspective on trading. But you're right, my specialty has been FX. And the way that I got into it was really from a young age. I got interested in trading probably when I was about 14 or 15. It was in the period of when Wall Street, the movie came out, Liar's Poker came out. So there was kind of like trading was in the zeitgeist at that time. And kind of one of the funny things is that those are both cautionary tales, really, right? They're like Michael Lewis wrote Liar's Poker more as a cautionary tale than as like an invitation to come to Wall Street. But and the same thing with the movie Wall Street, it's a cautionary tale. Yet both of them kind of were cool and attracted me to the idea of coming to Wall Street. Initially, I think I was attracted to the money side of it because, you know, Liar's Poker and the movies and all that make Wall Street look kind of like this glitzy place where you can make a lot of money, which is somewhat true. But then I think part of the reason it stuck with me, or I stuck with it, was not the money, but much more like the puzzle solving and math and sort of just like the fascinating idea of this extremely complex puzzle that can never really be solved, but all you're trying to do is like temporarily solve it long enough to make some money before the regime changes and everything changes. So that's why I've stuck with it for so long, is just that I really enjoy it. So there's an interesting aspect of that where my observation would be generally people that are in trading for the money don't succeed because it's so grueling and dispiriting sometimes that you have to have another motivation. And so I guess my like sort of underlying motivation always was fascination with math and puzzles. And that's why global macro appeals to me, because it's like this, you know, if you look at what the variables are in 2022 versus 2021 versus 2018 or any other year, it's constantly changing, right? And I think that's a really fascinating part of it that's kept me hooked on trading for so many years.
One of the things that fascinates me in terms of trading is how the environment that you grow up in as a trader tends to shape you in terms of opinions and trading styles, etc. I'm born and raised in a world without interest rates. So I admittedly really struggled this year with sort of a regime shift in interest rate markets. What was the environment like when you entered financial markets, Brent?
Well, so when I entered, it was actually before the euro, right? So coming into FX spot trading in 1995, 96, you know, there was the Deutschmark, obviously, and we traded Mark Spain, Mark Paris, Mark Lira. So in terms of currencies, that was a major difference. But also a really big difference now is the volumes and the number of players is so much greater now that so the microstructure is so much different. I mean, when I started, you were transacting through voice brokers. There was really like 3 or 4 major players in every currency, and then a couple of hedge funds that would participate here and there. And now there's just thousands of hedge funds, millions of retail traders. So the microstructure is very, very different. Like in those days, people would try to push the market around and stuff like that. And certainly that's pretty much impossible in FX now. Um, and then I think also now the monetary policy and sort of like central planning aspect of markets is very, very different. So I think it always goes to understanding the regime that you're in, but also being open to the fact that regimes are never last forever, and being ready for the new regime. So I think that's like a fundamental aspect of good trading, is understanding that, whatever you grew up in or what you made money in, because that's an important one too, is not just ones that you made that you grew up in, but environments where you made a lot of money. You tend to have some subconscious dream that that environment will come back. So, fast markets like 2008, a lot of people made a lot of money. And then everyone's playing for the next crash, but you can wait a long time waiting for that crash to come.
The first trade you wanted to highlight for us today was made prior to the dot-com bubble in the early 2000s. So please take us through the environment heading into this dot-com bubble and the trade that you wanted to highlight.
Sure. So when I started in FX, it was very flow driven, and there wasn't a lot of like risk taking as the way that I would think about it. And so I felt it was like a little bit like dealing blackjack all day or something like that. If you loved blackjack and you thought, oh, like I love blackjack, I'm going to go deal blackjack all day. And then you realize, oh, this isn't really all that fun because I'm not controlling the decisions. It's more like clients are just telling me what to do and I'm executing. And it was more of like a kind of a broker role. So I quit and I went home to trade the dot-com bubble. I went back to Canada and I did very, very well at first. Like I had $25,000 basically was my net worth. And I built that up to about $400,000 over about 2 years, from like 99 to '01 kind of thing. And that was a pretty good accomplishment because I was paying my rent out of there. I bought like an M3. I had a whole bunch of, I was spending a lot of money and still my account was going up a lot. And so the first trade, and this kind of references back to something I said before, was a bad trade in that so I had my certain methodology and it was the way that I traded, which was capturing a lot of bid offer on very high value stocks and using futures as kind of like the linchpin of direction. So like trying to get on the bid in stocks when the futures were rallying. In those days we had a squawk to the pit and you could hear like the volumes picking up and futures are starting to rally. So you get on the bid in a few stocks and try to make a spread basically. And so at that time, I wanted stocks that were very high valued because you wanted to transact the minimum number of shares possible because you were paying brokerage in those days, right? So you wanted to buy a stock at 100 and sell it at 101 and make, a dollar on 300 shares, that's $300, and you do that 5 times in a day, times 250 days, that's 400 grand. So that was kind of the way that I was trading. So every morning I would print out a sheet of all the stocks above $100. And it was like 4 pages in 99, 2000. And then then everything crashed, obviously. And by 2001, when I printed that off, there were only 4 stocks. So there were 4 stocks trading above 100 at that time. So it made it harder to find ways to capture big bid offer. But then after that, decimalization came in. So before 2001, stocks traded in fractions in the US. So it would be like 100 and a quarter to 100 and a half or whatever. And for that reason, mathematically, that meant stocks tended to trade wider. And there wasn't really an algorithmic aspect to stock trading at that time. There weren't algorithms front running, all the bids and all that the way there are now. So then decimalization happened and the stock prices had all gone from like all these stocks above 100 to basically none. And so what ended up happening was I was doing the same trade still, which was like riding the momentum of the S&Ps, capturing the bid offer. But the thing was, and I was still making money. So I was I was gross positive almost every day still doing the same thing. But I was paying so much brokerage at that point because if you're doing it with stocks that are trading at $50 versus $200, you have to do 4 times as many shares. So I was paying 4 times as much, bro. And so the fundamental thing that I didn't realize, or that I didn't, which seems really obvious in hindsight, was that we had entered a completely different regime, and I wasn't willing to acknowledge that because I had made so much money doing this certain strategy that had a lot of edge. And I wasn't able or willing to switch or to recognize, okay, this doesn't work anymore, so I'm going to stop doing it. I just kept doing it and trying to tweak it. And then so my account started getting smaller and smaller and smaller, because then I was paying so much bro that I was losing money. So really the bad trade there was to not recognize the regime shift and to just keep doing what's not working. And the thing though is that in a way I'm kind of glad that happened, because something that I've been really good at since then is, like I was referencing earlier, is understanding when regimes are shifting and adapting quickly. So for example, like people were making a lot of money buying buying calls on earnings in 2021. And like, so you bought Zoom 1 week Zoom calls 2 days before earnings and made like 20x on those. People were doing that quite regularly. And that stopped working in 2022. And I know from talking to a lot of younger traders who would be about the same age as I was in 1999, that people just kept doing the same thing over and over, even though it stopped working, kind of hoping, oh, maybe it'll work this time. Maybe it'll work this time. And in contrast, what you need to do is be a little bit early in recognizing the regime shifts. Because like when someone says to me, like, oh, I'm a really good breakout trader, but I'm not very good, in range markets, that's a huge red flag, because I think what you should be able to do is adapt to what the market's paying or what the market's rewarding. And so that was a very bad trade for me, because, I had to end up going back to get a real job because of it. But in the end, it worked out. And it's also an example of like, if you fail and you learn from the failure, then, I don't really chalk it up as a failure, because it kind of led to future success.
Being born in 1989, I cannot really say that I traded the dot-com bubble to any extent, but I wanted to pick your brain on the similarities between what we've experienced this year to the dot-com bubble. How big are the similarities between the tech sell-off this year and what you experienced during the dot-com bubble?
Very, very similar. So it's actually mind-blowing. So there's this, I read recently a quote that said, finance is the only industry or the only field where we don't learn. We just keep repeating the same mistakes over and over. So I remember tweeting something about Shopify and Zoom and saying like the price to sales were around 100. And to me, price to sales is a pretty clean ratio, because it's harder to fudge than price earnings. And I tweeted that and I said like Cisco and most of the things in 1999 got to like 40 or 50 times sales, and that was like extreme bubble. And I got millions of hate, like a lot of hate saying, Zoom and Shopify are changing the world and all this kind of stuff. And so like the biggest thing that is similar was people fell in love with the story and never looked at what they're paying for the story. Like no matter how good a company is, there's still a price at which it's too expensive, right? Like if you look at like McLaren F1 or P1 or whatever, like some super expensive car, yes, it's the best car in the world, but it's only still worth $1.2 million. If you pay $15 million for a P1, you're paying the wrong price. So you're getting a good car, but you're paying the wrong price. And when you go to sell that car, you're going to lose a lot of money. So I think that was one mistake that was very similar, was people being attracted to these stories and not understanding that there's only so much of a price that you can pay for stories. The other thing was, and it's kind of related, was like the religious fervor, around Web3, around the disruptors, around Cathie Wood and that whole ecosystem. It was very similar in 1999. It was B2B, which is like business to business, was like this is going to change the world. And it kind of did change the world. But, anyone that invested in that basically lost all their money. I guess the similarity from a psychological point of view was that there was this very religious feeling that this was like a watershed moment in technology and in history, and that was going to change the world. And it's probably correct both times, but that doesn't mean those stocks are good investments. In fact, it probably means they're bad investments. And my guess is that in 2040, we'll just do all the same thing again, and there'll be some other new technology, and it'll all be the same thing again, right? Because 1999 wasn't the first bubble either. There's been plenty of other bubbles, and I guess the difficulty though is that even having lived through 99 and 2000 and identifying in 2021, because I wrote about it a bunch of times, the similarities is that it's really hard to make money even if you know it's a bubble, because it's very difficult to short because of the timing has to be perfect. And so actually what a lot of people do is they just cynically go long the bubble thinking that they'll get out before everyone else. Like, I know it's a bubble, but I'm just going to ride it kind of thing. And that's very difficult too. So the problem with bubbles is that even when you identify them, which is, half the battle, it's still very hard to make money. So really in a bubble, I think part of it is surviving without getting your head blown off. And so I think like I did that well, but it's not like I was short everything. Like I was short a bit of crypto and stuff like that at a few moments and made money. But it is very difficult to short bubbles because the momentum is so powerful.
So right in between the dot-com bubble in the early 2000s and the pandemic bubble in the early 2020s, we obviously had the great financial crisis of 2008. How do you remember that crisis from a trader's lens?
Yeah, so that was a wild time. And I would consider that, so we're using like the term trade here a little bit more broadly, and not one trade, but more like a trading cycle or a way of trading. So the first one I described as a bad trade, which is I didn't adapt to a new regime. And then in '08, I think I did, that was a very good trade for me. It was very good for my career because I kind of saw it coming, not necessarily the subprime mortgage crisis, but more the change in markets was you could feel this visceral, like when someone sold 50 million Kiwi New Zealand dollars in 2007, it wouldn't move at all. In '08, you could feel like, man, it's impossible to sell. It's impossible to buy. There was pretty early on, you could feel that things were starting to break. And so in 2008, there was basically two things that happened. One was as a trader, one, you either like embraced it and said like, wow, this is a huge moment and I'm going to embrace risk and kind of be courageous, right? And so what I kind of did, so I was the dollar yen trader at Lehman Brothers, which is sort of like the epicenter of it because dollar yen at that time was trading off of Lehman Brothers stock because Lehman Brothers stock was kind of considered the barometer of the financial crisis for a long time. So there's a lot of like circular aspects to that. But at one point early on, I was just like, kind of said to myself, like, holy shit, this is absolutely huge. This is going to be a massive opportunity as a market maker and as a risk taker. So I kind of just decided like, I'm just going to not be scared and I'm going to go all in whenever it makes sense to do so. And because so many people had pulled back from risk taking at that time, there were just these incredible opportunities. So there were essentially two things that people did. One was like what I described, which was just embrace the risk and embrace the mayhem, embrace the chaos. And then a lot of people just went and hid under the desk and like hoped that it would be over. And so for me, like I made a lot of money in '08, but also I think my approach got recognized. And then that was like 1 year that kind of made my reputation for like the next 5 years because I was like one of the people that killed it during the crisis. And so the lesson for people listening, especially, people that are trading actively, is that it takes sometimes a certain amount of courage to take risk, and crisis markets and fast markets are the time when you make money, right? Like when it's slow and quiet, it's just harder to make money. Volatility is what you want as a trader. And what you'll see on a lot of trading floors is people complaining that it's not volatile and that this is so boring, these are bad markets. And then when the shit hits the fan, the same people are complaining that it's too volatile and there's no liquidity and I can't get out. So, you got to pick one or the other. And so I think when you identify as a trader, like, okay, this is a crazy market, you recalibrate because your position sizes have to match the volatility. But then in that framework, like in a contained risk-taking framework that's rigorous and that acknowledges, okay, you can't have the same position size now as before because it's much more volatile. But in that framework, you then go, okay, I'm going to be really aggressive and I'm not going to be scared. And, when the thing's down 2.5% and my instinct is to sell, actually, no, I know that like this is how overbought it got the last 3 times, or how oversold it got last 3 times. So I'm going to buy, even though it's, very scary to buy. So sometimes you have to be able to do the scary thing and have the courage. And so that kind of '01 lesson of identifying regime shifts, and then kind of my age and my experience in '08 kind of combined, and I was like ready for that moment. So yeah, that was '08 was definitely a very good trade for me.
If we look at the sentiment across investors in the early 2000s, in the dot-com bubble, during the great financial crisis of 2008, and the tech sell-off after the pandemic, what's your assessment of the sentiment we've seen this year in comparison to the great financial crisis and the dot-com bubble?
So there are some metrics that make it look similar to '08 in terms of, just sentiment of surveys and things like that. But to me, it's absolutely nothing like '08. And that's part of why I don't think 2022, I don't think this bear market is over, is that there's been very little fear. VIX has barely gone above 30. There hasn't been much panic in terms of, there's been moments of definitely of liquidation, and people definitely have been bearish. So that shows up in the sentiment indicators. But in terms of like that visceral, like, holy crow, this is the world's ending kind of thing. So there's usually 2 ways things end. Either that, which is like the world's ending and then the Fed bails everyone out, is one, or just that like absolute despair. Like at the end of the '70s, the death of equities was the cover of Business Week. At the end of 2002, I would say, people were like, stock market's stupid. It's a waste of time. I'm going back to be a dentist or whatever. Because a lot of people, actually, that's another similarity between 2000 and 2021 is all the people quitting their jobs to become day traders. So that was a very similar thing too. Is in 1999, it was E-Trade and the baby commercials and all that. And in 2021, it was Robinhood and the confetti on the app and all that. But essentially, it's the same thing, right? Is sucking in people to make them think that they can make money trading, but really what it is just that a bull market generates a lot of money for everyone. And when that bull market ends, then that separates like who's really a trader and who was just long and rode it up.
So, Brent, I wanted to ask you, after the great financial crisis, you obviously had to leave Lehman due to circumstances we all know. So what happened after? Where did you move?
Right. So I would put that again in the category of kind of a bad trade. But then I'll explain it, as it's kind of my philosophy. And I think it's sort of like the cliche of, failure can lead to success. And so if you view life as just this big, long series of experiments, which is kind of how I see it, then, failures are okay. It's just, not every experiment succeeds. But when I left Lehman, I went to a hedge fund. And so the environment is very different. And so initially it was very good. I learned a lot. But one really tough part of that transition was I went from like the chaos of a trading floor. It's fun. You're a part of a big team. You're talking to clients. I was writing a piece every day. So there was like this very dynamic job that I was doing that had all these different pillars to it, or different like lanes, I guess. And then when I went to the hedge fund, you're sitting in a quiet room. There's 12 people. Nobody's talking. All you hear is tippity tap on the keyboard. If you want to talk on the phone, you go to the phone room. So like nobody's talking at all. So that's like a pretty dramatic culture shock coming from like a team environment where everyone's screaming all the time and stuff. So that was one thing. But then the biggest thing that I found so I was at a hedge fund for 3 years. The biggest thing that I found that I missed, and the reason I didn't like being at a hedge fund was more like an individual thing. So the fund that I worked at was great. Like I sat next to the head of risk and he was like an awesome guy and I got along well with everyone. But the thing that I found was I really missed writing. So since 2004, I always wrote this daily, and it was kind of part of my trading process, right? So I'd sit down in the morning, I'd kind of like go through all the charts, go through read everything that was going on, and then come up with kind of my best idea or my like strongest thoughts, and then I would write them, send them out, and that became the anchor of my trading because it always at least forced me to think a little bit more slowly in the morning. And so when you work at a hedge fund, there's no audience for a daily, so I wasn't writing. And so what would happen a lot of times I found was I would walk in and it was the middle of the Eurozone crisis. So like there'd be a headline, Spain downgraded, and I'd just sell 100 euros kind of mindlessly, just on reacting to a headline or reacting to price action. And so I felt like my trading wasn't as good because I wasn't anchored on a firm plan. And of course, like I could write my own thing, but it's a little bit like, cooking for yourself or cooking for a group, like since I'm writing for an audience, my writing is a lot better than I would try to write for myself, but then you get distracted. And, I found generally that from a trading point of view, the writing was really valuable, but then also from an intellectual point of view. So going all the way back to like my 1998 experience, part of the reason I left initially was that trading flow wasn't intellectually stimulating enough. Like it was just too robotic. And so in a very different way, I found working at a hedge fund also wasn't stimulating both sides of my brain. Like, of course, it stimulates the math part and all that, and like the logic and puzzle solving part. But the creative part of my brain wasn't being activated. And I felt like that I didn't realize until I didn't do it anymore how much the writing just gives me satisfaction in life. And that's part of the reasons I've written the books about trading and stuff is just I like getting what's in my head out in via writing, and I feel like it helps me process things. It helps my thinking. Like I think it improves my thinking. And so what happened was the first year I was there, I did well. The second year I was kind of flat. And I didn't know if it was just like, oh, I'm not really making money. Maybe that's why I don't like it. So it's hard to tell sometimes if you're dispirited about trading or there's actually something fundamentally about the role that you don't like. And I couldn't really tell. And then the third year, I started out really, really well. Like I crushed it in the first quarter that I was there. And I still was kind of like dragging myself into work a little bit. Like I wasn't enjoying it as much as I felt like I should be. And that was kind of what opened my eyes to the role specifically of working at a hedge fund wasn't as good as I thought because it didn't allow me to do all these things that I enjoyed doing, which was, part of it, not just writing, but also I like talking to clients. And I also feel like part of my edge is this network effect of talking to a lot of people, and you get an idea of like, wow, like everyone I talked to today is bullish dollar yen and they're all like max long. That is a much more useful sentiment indicator than like looking at CFTC data that's from last Tuesday or whatever. So all that ended up being that I had gone to the hedge fund and I was there for 3 years, and I ended up, so I kind of felt like that was a bad trade on paper because, it probably cost me a lot of money because I would have made more money working at a bank for those 3 years, et cetera. But really, I learned so much from that experience, not only about like appreciating the dynamic role that I have now in a more deep way, but also, like I trade a lot of oil futures and gold, and I did a lot of different stuff like that. And also, one big difference of working at a hedge fund is the risk management approach is much more rigorous generally at a hedge fund than it is at banks. Just because that's essentially what they're built. Like that's what a hedge fund does. Whereas a bank is doing many things. It's talking to clients and market making and all that. So it's not just like a pure risk taking business. So I felt like I learned a lot about risk management, especially about scaling from smaller account size to massive account, like massive notionals. So I feel like all the stuff that I learned made me a better trader, but also I think it made me a better bank employee, like a better, person to talk to clients because I sat in the same seat they're sitting in. So I have a better understanding of what they need and what they want.
I left the biggest trading floor in Northern Europe late last year to join a private equity company within real estate. And I agree with you, Brent. The silence is scary as beep when you leave a trading floor and join a much more long-term setup.
It's tough, yeah, especially depending on your personality. Like some people like
Mhm.
that, right? But if you're an extrovert, it's harder. It's harder to be in that environment. You have to adapt for sure.
Brent, I wanted to move on to the last trade that you brought with you today, a good trade from the same period of time. So please speak to that trade and what you learned from it.
Sure. So that this trade is actually the forward to my book. So have you seen Indiana Jones, the original Indiana Jones?
Yeah, yeah.
So one of my favorite things about that movie is it just starts right away. Like the guy, he's walking through the forest and the blow dart hits the tree and everyone's like, "What's going on?" I always like movies that start like that. That's just one example. So I wanted to start my book with like something exciting or interesting, even though it's more of like an educational book. So I put the story of when I was at the hedge fund. So one of the ways that I trade is called lead lag or intermarket correlation, which is looking at other markets to try to get a clue of what your market's going to do. And so I'll look at like, say, what is crude oil doing and what does that mean for Canada, for Canadian equities or Canadian for the currency. And one specific thing that has worked for a very long time is looking at interest rates versus dollar yen. So I know you know this, Andreas. I'm just explaining in case people don't follow FX. But generally, Japan is the biggest pool of savings in the world historically. And so they want to invest in things that have yield. And generally, Japan doesn't have a lot of yield. So when yields go higher, Japanese money goes into those things. So they sell yen and they buy whatever that thing is. And the anchor of all that usually is US Treasuries. So if US yields go up, dollar yen goes up. If US yields go down, dollar yen goes down. And that's one of the truest intermarket relationships in FX since I started, and specifically like since 2005, I've been watching it very closely. And so there was a point in 2010 that would have been like late April, early May, when yields were starting to come off, and dollar yen was pinned very high for some reason. And a lot of times what that is that there's a reason these things dislocate. So the underlying driver of both of those dollar yen and yields is the US economy, Fed policy. And so, if the US economy is doing well and the Fed's going to hike, both of those things, yields and dollar yen are probably going up. And if things look bad in the US, both of those things generally go down. That's kind of like the reason that they both move together is there's the third driver, which is the US economy. But sometimes they'll dislocate. And one of the reasons that they dislocate is simply that there's flows in one market that don't impact that aren't in the other. So let's say like things are looking worse in the US, but there's a corporation that did an M&A and they need to buy $20 billion yen. So, yields start going tick, 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 tick lower, but dollar yen just stays up here because, that whoever that is, that corporation doesn't care what yields are doing. They're just buying their $20 billion yen. But then when they're done, dollar yen goes down and catches up to yields. That's kind of like the theory of, and I mean, it's really the practice of that's how it works. I mean, I've seen the orders coming through working at a bank, and those orders create distortions, and you're trying to identify them. So in 2010, yields started coming off. There was like people were getting a bit nervous about it. There was a bunch of stuff like people thought maybe that the bounce from '09 was fizzling. So the U.S. economy, it was like a mid-cycle slowdown kind of thing. The Eurozone crisis was starting. So people were kind of starting to get nervous. So yields started coming off, but dollar yen just would not would not come off. So I was short dollar yen, and sometimes these trades can be real, like smash your head against the keyboard type situation because it requires a lot of patience. and it doesn't work every time. So at some point you have to stop out, right? So I hope I have the levels right, but so dollar yen was around 99, and there was protection of a barrier there. So basically, one bank was selling like tons and tons of dollar yen right at that level. And so my stop loss was going to be above there. And so dollar yen was going up here and fizzling, going up here, fizzling, going up here, fizzling. And so this was going on for days and days. And I had a big position and I was trying to like just ride it out and like, good trading takes courage kind of thing. And like the market won't move when you want it to move, it just moves whenever it's ready kind of thing. So I have my stop loss there and I go out for a run. And in those days it was BlackBerry still. And my BlackBerry starts buzzing. I'm like, what the hell? And I just ignore it and I keep running. Then it buzzes again. I'm like, all right, I stop and I check and dollar yen was down like 200 points. And that like was a big move. I was like, oh, that's kind of weird. So it went from 99 to 97 or something like that. And on my position, that was decent cash. So I run back to the office and get back to my seat, and now dollar yen's at like 95.50 or something like that. But then, so still in those days, we had the squawk from the S&P, and I would encourage, I don't know, maybe we can link it after or something, but for people to listen to the squawk. So the day I'm referring to was the day of the flash crash in 2010 when stocks did the flash crash. So I had my headphones on and I had deadmau playing in there, and you could have two things playing. So deadmau is like EDM, and I had electronic music and the squawk going, and the squawk guy just starts going ape shit, like 50 at 60, 60 at 50, like Kentucky Derby style, like screaming. So stocks started collapsing, and then dollar yen's like 96, 95, 94, 93. And then, so it was like one of the best trades of my entire life. And so I start taking profit around 92.50. I probably have the levels wrong, but give or take, this is close enough. So I start taking profit around 92.50 or something like that. And then all of a sudden, I just like, when you're in the zone, you don't have a lot of time to think about stuff. And things were happening really fast. The squawk screaming in my ears. Everyone on the floor, even though it was a quiet floor, was like saying, holy crow, like stocks were collapsing and no one knew why. And so I had made one of those stupid like point of time decisions that like this has come too far, but I didn't have any logic. It was just more like a knee-jerk thing. So I start flipping long at like 92.50. So now I'm long dollar yen, and I was up like, I don't know, $4 million or something at that point of P&L. And then dollar yen keeps going and the flash crash continues. So it's like 92, 91, 90, 89. And then I'm sitting there. So I've gone from like 3.5 million or something of P&L. Now I'm up like 800 grand. And I didn't even know why I was long dollars. It was kind of one of those, like, I just did it reactively, like like intuitive feel that we had come too far. So now this like 1 week trade that I'd managed perfectly and sat there and been super patient. Now in the space of like, all this is happening probably in like 8 minutes or something like that. So in that 8 minute period, this whole thing that I had done perfectly for a whole week had now basically been zeroed, and I was almost down on the day. So then it keeps on going. So then I'm like, shit, I got to put a stop loss somewhere. So I left a stop loss at 87.49, and dollar yen goes, boom, 87.50 given, and then bounces. And then things started to stabilize for a second, and I could hear the flash crash guy, or the pit squawk guy, was like a little bit less crazy. And then I kind of came to my senses. And then, so even though now I was actually down like $1.4 million on the day, I was like, okay, this now is definitely going to bounce. You can feel like the electricity of the moment has subsided, and those crashy kind of moves require like a certain amount of electricity. And as soon as the electricity subsides, that's part of the edge of being on a trading floor, is you feel that electricity subside. So I bought even more, and then it starts ticking higher. And then again, so part of the reason I put it in the book is there's so many behavioral things that I did wrong during this episode. So like kind of like on paper, I had this great trade and I did it perfectly, but then I started doing all these behavioral things that are totally wrong. So one thing people do is they'll anchor on entry levels, exit levels, P&L levels. So basically, as dollar yen started going back up, and people sort of were realizing, okay, this was some kind of algorithmic weird thing that happened in stocks, and it made no sense. So like that's even more reason to be long dollar yen or long stocks. And so, but as soon as dollar yen got to the point where my P&L was back to high water, which was like 3.8 million or whatever, I was like, okay, thank you. I made a stupid mistake. I'm out. And then it kept on going. Like it went back all the way back up to like 96 or something. So I could have been up like $10 million that day. So I think it's a good story in that it kind of captures everything about trading, which is that like you need to have a plan, you need to execute the plan, but then you also have to avoid all the behavioral things, like whether it's panic, which I didn't do, but like doing trades with no edge just because it's come too far too fast, and all the dumb stuff. Even like very smart people do a lot of dumb stuff when they're trading. And so this trade kind of captured like all the smart things that I could do and all the dumb stuff that I could do or that many people do, all in one nutshell. And it obviously ended up being a good trade. But I thought it's just interesting from the point of view of how it captured. Like I think in the book I labeled like 20 different behavioral elements of the trade. Like it just captures everything that's great and terrifying and fun and bad about trading.
It's a really fascinating story, Brent. And it leads me to the final two questions I have. I ask these questions to all traders I interview on the platform because I find them so interesting in terms of how to risk manage over time. First question is, in a scenario that you just depicted with a flash crash running, how do you stay true to your risk management principles when everything is falling apart?
So that's a great question. And I think one thing that I learned was over the years is there's two ways to approach it. One, you can be disciplined and extremely disciplined and robotic. But if that's not your personality, at some point you recognize, which is what I did, instead of saying like, okay, next time I'll be more disciplined, next time I'll be more disciplined, what I came to a realization was like, okay, I'm not very disciplined in those situations. So instead, what I'm going to do is I'm going to automate my stop loss. So for me, that's a really important part of my process is every time I put a trade on, I always put a stop loss in a system. And of course, you can like override it and stuff like that, but that requires a little bit more effort. So creating friction or automate. So there's two ways you can do it. If you overtrade, what you want to do is create friction to make it harder to trade. Like don't have an app on your phone and stuff like that. And if there's something that you should be doing that you're not, then automate it. So either have like a person doing it, or have it automated, which is in FX because it's liquid. You can put stops and everything. So I think that's an absolutely critical part of risk management is automate everything you possibly can. And I think actually of the entire trading process, depending on, what kind of institution you're working at, if you can automate, the more stuff you can automate, especially around risk management, I think the more powerful and consistent your trading will be.
One of the sort of common traits of the best investors I personally know is that they can be basically long and short the same asset with the same conviction. So do you have any tips on how to stay true to that principle, Brent?
Right. So that's an interesting one because when I was a little bit younger, I used to go to visit all the clients, like all the famous hedge funds and all that. And I was always talking with senior PMs, but not the founder of the fund. And so I would always ask them, what makes that guy, it's always a guy in this case, interesting or different as a trader. And almost every single time, to your point, people would say, we'll go in the morning meeting and he's telling us why he's bullish and he's long 1 million shares of XYZ. And then I look at the report at the end of the day and he's short 500,000 shares of XYZ. And so that's kind of this concept of strong opinions weakly held. So you have to believe in it's a really tough because they're conflicting ideals, right? The ideal is you have to have super high conviction and believe in what you're doing and have the courage to go all in when the time is right. But then you also have to be receptive to new information that contradicts what you thought 3 hours ago. And so, in a bad expression of that, what it can lead to is just you're selling the lows and buying the highs because you just keep changing your mind. So what you have to have is a strong framework that leads you to decisions, but then clear reasons why you'll change your mind. And I think that's a good way of looking at it is you have reassessment triggers. You say either technically or, if I'm doing this trade because oil is doing something, then if oil reverses, obviously this trade doesn't make as much sense and I'll reevaluate. So having more like logical reasons to reassess and not just reacting to price action and buying and selling, buying it because it's going up and selling because it's going down. And that's a really, really hard thing to do. But I think the ability to flip, in my opinion, is a really strong characteristic of a trader, but it's very difficult.
It truly is. Brent, it's been a pleasure to unpack your life as a trader in 4Trades. Ultimately here, if our audience wants to follow your thoughts or read your books, where can they find them?
Sure. So I'm on Twitter. That's an easy one. And then if you go to spectramarkets.com, that's the website for my company. And you can see all my writing. And my newest book is called Alpha Trader. It's on Amazon or anywhere books are sold.
Good stuff, Brent. Thanks so much for joining my life in 4Trades, Brent.
All right. Awesome. Thanks, Andreas.
All right, that's a wrap on this week's edition of My Life in 4Trades. For more on the series, visit realvision.com/My Life in 4Trades. Make sure to use the numeral 4.
Hey everyone, thanks for watching. If you like this show, you're going to love Real Vision Essential. At Real Vision, we talk to the most successful investors in the world and deliver videos that make finance interesting. It's all about helping you become a better, more confident investor. Now we could dress that up in fancy marketing buzzwords, but it's really that simple. Oh, and right now, you can join Essential for $99 for a full year instead of the usual $239. Visit realvision.com/essential99 to join the Real Vision community. That's realvision.com/essential99.